Today I'm going to discuss the impact of the weakening currency on the market itself and the divergences that we are really seeing. If I just go back some time, I've been bullish on the USD-INR for quite a while, expecting that it will probably surpass the 80 mark at some point. And the equity and currency markets tend to be inversely correlated, which means whenever equities fall, the USD-INR tends to go up. And in the same way, when equities go up, the USD-INR appears to go down. Now, there are very short periods of time when they tend to break away this correlation, and then those become interesting periods to really study what is going on. What's also true is that in the past, whenever we've seen currency devaluations, we've actually seen pretty fast moves in the currency pair. So I've actually, if I go back to say 2013 or 2011, you could see 3-4 rupee moves, 5 rupee moves within a month or two when those periods of weakness in the currency would show up. And they often would show up, either they would be related to FI outflows, or they could be related to oil, or they could be related to too much of gold buying. One of these three have been the major factors driving the underlying pair. Now, one of the things which happened after 2013 when we hit 69, Raghuram Rajan came in as the governor of the RBI. He did a lot of swaps with, got them with Japan and tried to actually intervene in the currency market and slow down the pace of weakness. And so after that, whenever we would see weakening, we actually seen much more slower moves in the underlying pair compared to the kind of volatility we would see before. So somewhere I've sensed that the RBI has moved towards a policy of low currency market volatility. And unfortunately, what that means is the RBI is going to intervene in the market over and over again. So it doesn't mean that we don't get to the destination of a weaker level, but at a much slower pace. Now, it's a little frustrating as a currency trader because you usually take a view, look at the setup, and then you expect a certain size of the move to really take place in a period of time. And then if it starts taking much longer than you thought, it really tests your patience. And especially what we've seen over the last few days. In fact, I should compare what's happened in the last few months. I think it's only till actually May, even though I was sensing this move, I was really not looking, at whether the USD-INR will make a big move, because it had been gyrating below the 77 mark multiple times up and down without really breaking out. So I had changed my views back and forth many times on the currency pair, every time thinking whether it's an ending pattern or whether it can actually extend higher. And so in fact, even sometimes thinking whether the ending pattern was truncated, because whenever the market would start rising, the currency pair would pull back a bit from without really breaking past the 77 level. So it would never complete that E of an ending diagonal that I was originally thinking of. And so it looked like, okay, is it really truncated, and therefore the pair will go down from there? And so neither of that happened. The market peaked out and started to roll over. And what's really been the case, as we can now see in the RBI data, is that they've intervened significantly. Even though we had large FII outflows, they've intervened in the currency market and tried to really slow down the pace of the weakening. Now, when you do something like that, the real question is it a one-off? So in case of FII flows, yes, if they reverse, it can be a one-off. But if your country has a twin deficit problem, and especially a trade deficit which it has to finance, and it's financing that through FII flows, and if your currency is not the reserve currency of the world, then you really have a problem in terms of how do you make those payments. And so your currency starts to weaken. Now, for the US, it has a twin deficit problem. It has to import from the rest of the world. It can print the dollars required. And so it doesn't always result in a currency devaluation outright at that point of time, though they've increased the supply. And so it's psychologically a weaker currency, but not in actual price moves. But for India, the problem is slightly bigger. We can't simply, print dollars. And so we have to pay for them. And if we actually selling our reserves to really manage the currency, then we are presuming that there will be inflows from foreign investors either through FI, FDI to rebalance the entire equation. And if not, then at some point in the future, you'll have to stop putting that. I mean, the pressure guard will get lifted and prices will start moving, against you. So here's what I think has really transpired. The first point at which I felt that the RBI is really taking its foot off the pedal was when it started to surprisingly raise interest rates mid-policy just before the Fed was meeting in the mid of May. And when they did that rate hike overnight, I sense that was the first sign that the RBI is backing off from, managing the currency by selling dollars to managing the currency through interest rate, policy. So if they're using interest rate policy to manage the currency, then that means that the currency pair should then reflect more the real underlying movements, and the currency war is fought by rates alone. So initially you saw just a 1 day dip in the currency pair because of the rate hike, and then it started to weaken pretty rapidly. So that's the point from where I thought, okay, you're getting a trending move in the pair. But after that it hit 78.30 and has been, sort of trying to hit against this trend line, which is the trend line of all the highs of the last year, and really was not breaking out. So once again I started to wonder, is this the intervention is still on at some degree in the background, because we are really not breaking past this level, and the market already last week fell to 2 weeks back I think fell to 15,100 and started to rebound, and then shouldn't the pair really cool off from here? Now it didn't cool off, and that's where I think I've been surprised, because naturally if equities are going up, you have a tendency to expect that the currency pair would weaken, that is USDINR would go down. Instead, in the last 2 days, we just broke past it 78.30 and have now crossed, sort of trying to cross today the 79 mark. With that, the RSI is now at around 75. We've seen peaks close to around 80. So there's that room for a little more push up before maybe it cools off. But having said that, there are two things we can think about it. One is, of course, that it's a lead lag happening. Whenever markets top out or bottom out, there's an intermarket divergence between the two. So we call that an intermarket divergence, which means that one of them does not confirm the other. So if you have a new low in the rupee and it is not confirmed by a new low in the Nifty, that's a bullish intermarket divergence. So, unless the Nifty sells off and confirms it tomorrow or day after, it ends up being a bullish divergence that is really built into price. So if that's the situation, the other thing which really speaks out here, which tells me that why can't you actually have a persistent period for some time? These correlation breaks are not permanent, but for some time, where the Nifty and USDINR both go up together, which is the question people have been asking me for the last 2 days. How's this happening? And just a few days ago, there was a note put out by RBI talking about a possible black swan in the currency market. Now, of course, they were not saying there's going to be one, but they were simply giving a test case that if certain scenarios play out, then there could be a $90 billion outflow. And then people started saying, is there a $90 billion outflow coming in the market? And I was like, no, it's like markets just played out and they've already intervened. So where's the outflow? So one of the ways this thing gets managed is that, if you have a lot of buying pending, say, for example, you have buy orders for oil, or you have certain orders to be filled for FIs, the RBI can actually delay the oil buying. There can be particular dates that all the buying will take place after this date, or the banks will only press through their dollar purchases after a particular date, and so you can actually delay those purchases. That's another way that the currency can be managed. And so in the short term, we feel the RBI is intervening, but they're not directly intervening in the by selling dollars, but what they end up doing is that they intervene in the market by simply dealing the buy orders, and then later on, maybe when they wrote this note, and so this is where conspiracy theory comes in. There's no way for me to really know what the RBI did, but I would sense that maybe they let the lid off on that, which is they allowed those purchases to come through, and which is partly the reason why the pair is really moving so fast right now. So all of this happening at the same time that they write this note about a potential buying risk, and then the actual buy orders flow into the market and the pair starts moving at a much faster pace than it did earlier because they were holding it back. So that's just my theory. It would have to be verified through actual data. What we do know is that they have intervened before and they have used these type of measures before, and so it's not really new if they did so, and the divergence then gets explained. The way I explain it is it's an intermarket divergence. I look at it as a bullish sign if the two are not conforming to the same pattern, and if that is true, you end up getting a short period where they both appear to be going up together, Nifty and the USDINR, and eventually the correlation will go back to the normal correlation where the USDINR will get overbought and roll over. But in the short term, while both are rising, the positive rub-off can come on the very oversold IT sector, because usually the IT sector, I always say this, don't look at a weak currency as bullish for IT on an immediate basis only after the currency pair rolls over. But at a time when both are going up together, there's actually a bullish sentiment for equities, and in that environment, if you get a weaker currency, then it can actually be taken as a positive sign for the sector. And I think that's sort of the setup, because we've had a big sell-off in IT. The IT index may be very, very oversold. I would sense that it's likely to give you a good rally as we head into the earnings season. And Indian IT sector being more services driven rather than the US IT sector, even though the IT index is correlated with the Nasdaq, being a different sector, the earnings may surprise less on the downside. In fact, they may more or less be around expectations. And if there's a slight positive, the oversold condition actually helps the case for a rally. And then if you get a weaker currency, that further helps the case of a rally in the IT sector. So I think that's the sector I'll really be looking out for in the coming weeks as we head into the earnings season. That said, people still asking me about what the market view is. I continue to think it's a counter trend view. Bounce that is really happening in equity markets, that is the Nifty, is retracing the sell-off that we've seen over the last few months, and once that retracement is over, we'll watch out for signs of another decline. But it's still early days there, because we got a little oversold here, which is what I've explained, I think, in the last two videos that we really put out, and the podcast as well, that we'd reached a sentimental extreme from where the market is really cooling off to the downside. And so having reached that extreme, I think it's time to really hold back on those bear fangs, if I might call it, and allow for the bull horns to push prices a little higher before we really get another leg down. So that calls for some patience. I know it's been a weak market, and so people are very impatient. They just want a slight bounce and then a fall again. That's sort of the sentiment I'm sensing. Of course, I'm not sure how across the board it is, but I go by data. So if my data says that people reached a bearish extreme, and there's a case for short covering by FIs and many other things, then probably that's the sentiment out there. Slight bounce and it's going to fall. But the market will then start surprising people who are looking for that, and will continue to surprise till the consensus slightly shifts to the bullish side. A lot of the negativity gets taken out, pessimism cools off, and people start getting a little more optimistic, and that's where you probably get a rollover in prices again. So that will call for some patience, and watching what the market does over the next couple of weeks. And in the meantime, I'll be watching out for what the currency pair really does. And as of now, I think it's a bullish intermarket divergence that we are probably witnessing. It's not really a runaway move in the USD/INR at this point, but yes, medium term probably has more upside. So with that, signing off for the 29th of June 2022, and see you all again until next time. Bye.